This is your LMAX Exchange technical update for Tuesday, February 28th, 2017. Eurodollar. So the question that we've been asking over the past few days with the euro is still out there right now, and it's important to pay attention to key short-term levels above and below. Above, we're looking at 106.80. That's the high that we saw recently that goes back to the 16th of February. And below, we're looking at the recent low that we saw in the previous week, which came in at 104.94 on the 22nd of February. A break above or below is going to be critical in the short term to help determine which way this market could go on a more medium-term basis. If we push back above 106.80 and hold above 105, the market could be putting in a inverse head and shoulders on the daily chart, which ultimately could project gains towards the 114 area in the weeks ahead. Of course, we would need to break back above 108.75, which is that neckline area of the inverse head and shoulders formation, to confirm the outlook. But again, a push above 106.80 and a close above 106.80 will strengthen the possibility of the formation of this right shoulder and a bullish formation here. On the other hand, if the market is unable to establish above 106.80 and breaks back below that recent support that we saw in the 105 area at 104.94, this will suggest that the market is ready for a bearish resumption back towards that critical 14-year low that we saw in January at 103.41, which guards against parity further down. So again, over the coming sessions, 106.80 above and 104.94 are the key levels to watch, which could have a major impact on the medium-term direction in euro dollar. Sterling dollar. So cable continues to consolidate after recently stalling out below the December 2016 peak at 27.75. There is risk for a bearish resumption now, but the market will need to break back below the support that we saw on the 7th of February at 23.47 to strengthen the bearish outlook and accelerate declines back down towards that critical multi-year base, that low that we saw back in October of 2016 at 118.41. At this point, on a very short-term basis, the market would need to push back above recent highs that we saw around 125.70, 125.71 to take the immediate short-term pressure off the downside. But again, ultimately, a push above 27.75 would be required for a structural shift, a bullish structural shift. Dollar yen. So dollar yen continues to trade very well offered into rallies, and the market is poised for a fresh downside below recent support at 111.59, which will expose a measured move objective in the 109.50 area further down. At this point, rallies continue to be very well capped, and only a break back above 115.62 would compromise this shorter term bearish outlook for dollar yen. Euro Swiss. So despite some gains in Euro Swiss over the past few sessions, the market continues to be very well offered into rallies up towards 107, and there is risk for deeper setbacks as this overall bearish consolidation takes form and opens the door for a break back below the 2016 base at 106.24, exposing an acceleration towards 105 psychological barriers further down. Only above 107.60 would compromise the bearish outlook for Euro Swiss. Aussie dollar. So Aussie has seen a very impressive rally in 2017, with the market trading all the way back up towards some critical medium-term resistance in the 78 area. At this point, there is risk that the market stalls out here in favor of a resumption of declines, though we do need to see a break and close below 76 to strengthen this outlook and accelerate. Dollar CAD. Dollar CAD setbacks over the past several days have been very well supported above 130. We did see a minor dip below 130 several days back on the 31st of January, but the market was unable to establish a close below that psychological barrier and continues to successfully hold above it on a close basis, which suggests that we could still be basing out here in favor of a resumption of what is a longer-term constructive outlook for dollar CAD. Of course, the market will need to establish all the way back above highs that we saw on the 20th of January around 133.88 to strengthen this outlook and accelerate gains back towards the multi-day peak in the 135.90 at 135.99. Kiwi dollar. So Kiwi continues to show signs of topping out on the daily chart. The market had put in a high back in 2016 at 74.86, just shy of 75, before trading lower, then trading up to put in what could be now a lower top just ahead of 74 at 73.76 ahead of the next major downside extension. Look for a break below recent support in the 71.30 area to strengthen this outlook and accelerate decline all the way back down towards some medium-term support, which now comes in the 68s, going back to late December of 2016. At this point, rally should be very well capped ahead of 73.76. SPX 500. The S&P 500 continues its record run, with the market pushing to yet another record high in Monday trade, up just through 2370. The clear focus on the upside right now is on next key psychological barriers at 2400, while a break back below and a close below 2350 would be required at a minimum to suggest that the market is putting in some form of a short-term correction to allow for some significantly stretched daily studies to unwind. But until we see a close below 2350 at a minimum, the pressure does remain on the top side, and the market is focused on a test of that psychological barrier at 2400 further up. Gold. So gold continues with its impressive recovery over the past several months. The most recent break that we saw just through 1260 now sets the stage for the next major upside extension towards 1300 in the days ahead. Any setbacks here should be very well supported ahead of 1200, with only a break back below 1180 to compromise this newly adopted constructive outlook for the gold market.